Hello everyone, welcome back to our channel. This is Vaibhav Bansal. Today we are going to start with our new chapter in the DT exemption series for November 24 examination, which is MET and AMT Detailed Full Concepts. Okay, so in this I have already shared the notes and the question bank of the AMT and the MET chapter in my Telegram channel. If you want to download that chapter, you have the link in the description box. You can download from there. Okay. From before starting the session, I just want to let you know that take a copy and a pen with you, as we are going to do some notings as well in this chapter. Is this clear to you all? Next thing, what we are going to discuss is we are going to discuss we are planning how our class is going to be today. So first we are going to understand the very basic of the minimum alternative tax. Then we need to switch to the most important part, the computation of the book profit. Okay, this is the most important part from where you will get the most of the questions of ICAI, the additions and the subtraction list. Is this clear to you? We'll do it very easily and very logically. I'll give you the explanation and the reason of each point, why it is added and why it is subtracted from the list of the book profit, and why the base is called why the base is taken as the book profit. Okay, we'll go in each and every detail wherever possible, that this needs to be taken care of. After understanding the reason, you do not need to cram any of the provision, why it is added and why it is subtracted. You will at the end able to understand and retain as well what points were added and what points were subtracted with the reason itself. Is this clear to you? Okay, then we'll move towards the important remarks, the important points that you need to taken care of while solving the questions. Okay, then the Ind AS rationalization of met provisions in line with the Ind AS, with the AS, how it will be treated will also taken care of. Then the transitional adjustment, effect of book profit in a case of applicability of APA and the secondary adjustment. This topic needs to be done with the transfer pricing chapter. So here I am holding it, and with when we are completing the transfer pricing chapter in our DT exemption series, I'll be able to explain this to you in a very easy manner. So this topic will be done in the transfer pricing chapter. Okay, then the MET credit and AMT. If you understand the MET, the AMT is just a matter of 5 minutes, not more than that. Is this clear to you all? This is our first session that we are going to discuss today. And in the another session, the practice session will be the another session where we'll do the MET and AMT, the question. The file where the question and answers and the concepts are already given in my Telegram channel. If you haven't joined that, please do join. Please do consider to join that and download the file with you. Take copy and pen with you and write it down as I am writing it in my board notes as well. I'll be writing in the board notes. See, so you also have to write it there. Is it clear to you all? This is the structure our class is going to be. So before starting, firstly, I just want to let you know this is our third session on the DT exemption series. If you haven't watched our DT exemption series, two chapters which we have completed. First is the text on reconstitution or dissolution of firm AOP BOI, and the double taxation relief. Both the chapters with the question and answers have been uploaded on our YouTube channel on which you are seeing this video. So just consider my request and just watch those lectures as well. You will be able to understand the logic behind the section 9b and 45.4 as well, and you will able to solve each and every questions with very ease, as I have done that. I have break the whole provision section 9b and 45.4 in just 4 steps, and I have also given the I have also given the steps to solve the double taxation relief chapter in 7 steps with the important adjustments. I have given a 9-pager important adjustments for the double taxation relief that you will also need to consider. Is this clear to you all? Now we are moving towards our minimum alternative tax chapter. Is this clear? Okay. So, firstly, we are moving towards C, alternative tax. First, we are moving towards what this chapter signifies. This chapter signifies it is an alternative tax. Alternative to what? Alternative to normal tax provisions. Normal tax provisions to the company. Okay, it is an alternative tax. Then why it is minimum alternative tax? What does that word minimum signifies? So for that, to understand that why it is called minimum, we have to know the story. Okay, so I am just explaining a story behind the provision of the minimum alternative tax. By this provision came into picture. So just listen to me a story, then it will be very clear to you why this provision has came into picture. Okay, and if you know the story behind the minimum alternative tax, then you'll be able to correlate how these points are added, why these points are added, and why these points are subtracted. Either we'll also do the reasoning of each provision, but the basic structure of the math you should know. Okay, so let's start. See, this is the story of 1996 when our finance minister was P. Chidambaram Sahab. Okay, he noticed one thing. What he noticed that the blue chip companies, the companies which are high in turnovers, showing their profits high in the EGM financials. In which financials? That financials which are to be shown in the AGM. Okay, and distributing the higher dividends. But when it comes to the Income Tax Act, what they are doing, they are reducing the profit for income tax purposes. They are reducing the profit for consequence to which the nil or negligible tax is to be paid. The nil or negligible tax is to be paid. Now, how the finance minister P. Chidambaram Sahab wanted to know how this provision is going on. Why the companies are able to show the higher profits in the books of account, which needs to be shown to the shareholders, and why and how they are able to show the less profit in the Income Tax Act. So, in respect of this, the finance minister get the reasons. What are the reasons? The finance minister get the reason of the depreciation and the method of depreciation. The main reason was depreciation and the method of depreciation. Is this clear? The depreciation and the method of depreciation. How is it? How these were the reasons? See, in the Companies Act, the SLM and WDV both were allowed, but in the Income Tax Act, only WDV is allowed. Only WDV is allowed, and the SLM is allowed only for the few companies like the power generating units companies. Okay, that you have already studied in the PGBP chapter. If you have not studied, I'll going to take the session on the PGBP as well in our DT exemption series. Okay, so in the income tax side, the WDV is only allowed, but in the companies at the SLM and WDV both are allowed. What are they doing? They are following either this or this. They are following either SLM or WDV. They are following SLM in Companies Act, but when it comes to preparing the profit or loss as per the income tax, they are following the WDV. So it impacts the profit as well. Is this clear? The point is clear. The method of depreciation, how it is impacting the profit of the companies. Second was the depreciation rate. As per the Companies Act in 1996, the plant and machinery and all are what only depreciated at the rate of 1%, 2%, 1.26%, something like that. The depreciation rate was very low at the Companies Act. Is this clear? Secondly, now, in income tax act, what is the rate of depreciation on the plant and machinery? It's 15%. So the companies were able to charge more depreciation on the income tax act as compared to the financials made in the AGM. Is this clear? So the companies were able to show the less profit here. Okay. So this was the main reason that the government are saying that the companies who are the blue chip companies who are high in turnover are also giving or are also showing the profit nil or negligible, so that our revenue, the government's revenue through the income tax, gets cut. This is the reason why P. Chidambaram Saab wanted to take a minimum tax. See, this is a real example. The Reliance did the same. The Reliance were doing the same. Reliance has a team of a chartered accountants, 20, 30, 100 chartered accountants who whose job just that they just need to find the loopholes of the law and use in the favor of the Reliance. This was their job. So the Reliance did the same and made the two PNLs, one for the EGM and second one for the Income Tax Act. Is this clear to you all? The P. Chidambaram Saab just wanted to plug that profit. Okay, so what P. Chidambaram Saab said. See, this is the profit that you are offering, on which we are getting the nil or the negligible tax. Okay, we does not want this tax. We want at least a minimum tax from you. That is why the word is called the minimum alternative tax. It is alternative to what you have computed as per the PGBP income, but we are taking this as a minimum. That if your income comes through the profit and loss of through the PGBP income is less than what we are saying in this chapter, the minimum alternative tax, you have to pay what? Minimum this tax. You have to pay minimum the MAT. It is okay to you all? Is this clear? So it is a minimum alternative tax. What is a minimum alternative tax? See, minimum alternative tax. It overrides the other provisions of Income Tax Act. The P. Chidambaram Saab said it overrides the other provisions of the income tax. Forgot what you have learned in the PGBP chapter. This is the whole chapter in itself. It overrides the other provisions of the Income Tax Act. This is the only provision which says it overrides the other provisions of the income tax. Scrap the whole Income Tax Act. This is what it is saying. It is starting with a non-obstante clause. The technical language is the not is obstante clause, which is a notwithstanding clause. The section start with notwithstanding clause that it is called as, in the technical language, it is called as the non-obstante clause. So the minimum alternative tax start with a non-obstante clause that it overrides the other provisions of the Income Tax Act. Is this clear? The first thing is clear. Now, the minimum alternative tax is applicable to which type of companies? It is applicable to all type of companies, whether it is private company, public company, Indian company, foreign company, banking company, insurance company, electricity company, government company, etc. Any type of company registered in our country will be covered under the net of the minimum alternative tax. It is a minimum tax that the company need to pay. Is this clear? It is a minimum tax. So, what is the provision? The income tax payable under the normal provision, under the PGBP provision that you have studied. Under the normal provision plus surcharge plus health and education says, if it is less than the book 15% of the book profit, it is the MET provision. MET provision says you have to give the 15% of the book profit. Okay, plus surcharge plus health and education says if the met provisions the tax under the met provisions is higher than the tax under the normal provision, then you have to pay minimum what? Minimum the alternative tax that the government is going to tell under the section 115 JB. Is this clear to you all? Clear? Now, what is the book profit? See, book profit, the government says that the book profit shall be deemed to be the total income of the company. That is mean what? Total income. I am repeating again, it is a total income. It is not a gross total income. Are you understanding? It is not a gross total income. It is a it is a total income means we have already given, or you can say we are not allowing any deduction under chapter 6A or any exemption written under section under the any provision of the income tax act. Why? because it already overrides the other provisions of the Income Tax Act. It already overrides other provisions. So this is what the government is saying. What we are saying is to be treated full and final. Shall be deemed to be the total income of the company. Is this clear to you all? Clear? Okay. Now, what is the total income? We have calculated the book profit as the total income. Then it should be multiplied by what rate? The minimum alternative tax is at the rate of 15%. Is this clear? Plus applicable surcharge, and the education says that we all know. That becomes the final sum payable. Is this clear? The total income multiplied by 15% plus surcharge plus health and education cess. This is the total tax payable by the company. This is the minimum tax to be paid by the company. If the normal provision tax becomes higher than the MAT provision, then this needs to be paid. The normal tax to be paid, as this is higher. We need minimum tax, not the only tax. We need this as a minimum tax. So if this is the normal provision tax is higher, then we'll take the normal provision tax. Is this clear to you all? Okay. Okay. Now, as I said, the foreign company. I have made a asterisk on this. See, hashtag on this. What before coming on the companies, let's first start with the Met provisions does not apply to the foreign companies. It applies, but to certain conditions, they does not apply to the foreign companies. See, when the provision of Met will not apply to a foreign company, first thing is that when a company has a DTAA but it does not have a PE in India. PE, you can suppose PE can be referred as a branch office or a permanent establishment, permanent office of the foreign company in India. It is known as a permanent establishment. There is a whole article explaining the permanent establishment under the chapter DTAA and under Article 5. So we'll study there. So till now, for this chapter, just understand this. The PE is a branch office or a office, the permanent office that is in India of a foreign company. So if there is a DTAA between the two countries and the other country company have also the permanent establishment in India, then the MET will apply. But when the MET will not apply, when the DTAA exists, but permanent establishment does not establish. Okay, is this clear? The permanent establishment should not be there. The DT should be DTAA can be there. So the MAT provisions will not apply. Second thing, when we do not have a PE, sorry, we do not have a DTAA with the other country as well. And secondly, the company, the foreign company, not required to take any registration in our country under any other act. See, what is the condition? The company does not have a DTAA in India. The country does not have a DTAA with India. Secondly, the company does not require any registration in India under the any other act. Then the MET provisions will not apply. So the MET provisions will not apply in two cases. First is the DTAA exists plus permanent establishment does not exist. Then the MET provisions will not apply. Then in the other case, DTAA also not exist and the company does not require to take registration under the any other act under of India. Is this clear? In these both conditions, the MET provision shall not apply to a foreign company. Then there is another provision. In the another provision, the provision is given for the shipping business foreign companies. The companies which are running shipping business in India, they are running the shipping business, so they need to give the tax on the presumptive basis. That in India, if you remember, there is a section 4480, 4480A, which allows the business and the profession to give the income or give the tax on the income on the presumptive basis. That in India we know the 8% or the 6%, and for professional it is 50%. That is a deemed income, the deemed presumptive income. So similarly, there are sections, section 44B, 44BB, 44BBA, and 44BBB. These are the four sections for the shipping business. Here also we are giving a presumptive taxation to these companies. Okay, so we are giving a presumptive taxation at 7.5%. Now, what is the MAT rate? MAT rate are 15%. So the government does not want that the shipping business closes their operation in India and switch to any other country. So just to benefit them, just to keep them indulged in India, they are saying that the company which are already paying tax at the 7.5%, we are not charging MAT at the rate of 15% to them. They can continue to pay their tax on the income, which is 7.5% itself. Is this clear to you all? Is this clear? This is the provision where the where the Met provisions of the foreign company will not be attracted. What are the provisions? Just recall it once. First is a DTAA exists and the permanent establishment does not exist. Then the DTAA does not exist and the company does also not required to take registration under any other law in India. And third one is the shipping business giving the tax under the presumptive taxation at the rate of 7.5%. Then these companies are also not required to pay the taxes and as per the MAT provisions. But for this, there is also one condition that the TDS or the tax has been deducted at such rate. Okay, so see. The total income comprises solely of income of business referred to under section 44B, BB, BBA, and BBB, and such income has been offered to tax as per the rate of those sections, and the tax has been deducted as per those sections, that is 7.5% are the deemed income. Is this clear to you all? Clear? No. Now we are coming to the company. As we said, the it is applicable to all type of companies and the book profit shall be the 15%. The MAT will be the 15% of the book profit. The government just wanted to give the benefit to the IFSC companies. What are the IFSC companies? See, IFSCs are located. There is one IFSC in India that is also in Gujarat, known as the Gift City. Okay, known as a gift city. It is a international financial service sector for the IT sector only. If you are a manufacturing company and just wanted to locate in the in IFSC, then you will not be able to locate in there. Only the IT sector will be able to locate in the IFSC. The government wanted to increase or expand their IT sector in the foreign world as well. They just wanted to grow our IT sector, so they have established a IFSC IFSC city, which is known as the Gift City in Gujarat as well. Where what is the condition for the IFSC? That your import and export both should be in the foreign currency. You will not deal in the Indian currency. The both import and export should be in the foreign currency. This is not relevant. I just explained you just for the sake of the knowledge. What is IFSC? Is this clear? If the government want to promote the IFSC, then the 15% rate is not the government slashed the rate of the 15% to 9% for the IFSC companies. Okay, so they should the income derived should be the from the convertible foreign exchange. Just wait for a second. Yes, income derived solely from the convertible foreign exchange, then the rate should be 9% instead of the 15% because the government want to give the benefit to the IFSC company to promote them. Is this okay to you all? This is the whole basic that we just discussed. What is minimum alternative tax, why it has been levied, and what are the minimum applicabilities, that on which type of companies at what rate the minimum tax will be applicable. Okay, now we are coming to one point. We have discussed this. We have discussed the 15% or 9%. Okay, now we are now discussing the book profit. This is the most important thing. Now the said government gave the explanation to the what is book profit. So see, this is very important. This is going to be very important. The government under the explanation 1 of section 115 JB said what is book profit. Book profit means what government said. It is means. When the word means comes, that means it is exhaustive. The meaning is exhaustive. The government said what we have written in the provision that will only apply. Nothing else will apply. If you want to take any other deduction which we have not mentioned here, will not give any type of deduction to you. That's why it is means. And why it is means? Because I already said it overrides the other provision of the Income Tax Act. It overrides. So it overrides. So the business book profit needs to give its own definition, which should be in exhaustive sense, because we will not be able to include any other thing or deduct any other thing, because it's already override the other sections of the Income Tax Act. So the government needs to give the means definition, the exhaustive definition of the book profit, that this needs to be considered. Apart from these things, ignore everything. Is this clear? So this is the exhaustive list. If you are solving the MET questions, remember one thing: these points which we are going to study, the 10 points, if I am not wrong, the 12 points in the add and the 10 points in the subtract, these are the only adjustment that you need to taken care of. The 12 points can only be added and the 10 points can only be subtracted. Nothing else can be given under this provision. Is this clear? You will not give any effect to any other thing in this provision if it is already written that the book profit means, that is, it is a exhaustive meaning. Is this clear to you all? Clear. Now, coming to this provision. Now, what is the problem? The government wanted that the assessee company, that is a company, will should give tax on the income, on the profit that they are showing to the shareholders in the AGM. The government wanted that, but what the companies are doing? The companies are making a income tax profit and loss, the separate profit and loss for the income tax purposes, and claiming the more deductions, more depreciations, resulting to which the income either reduces to become negligible, or the income becomes nil. Is this clear? So the government wants to take the tax on the income which are showing to their shareholders. So the government said the base financial statement should be the statement which are presented in the AGM. Is this clear? If the government did not say that, then what the companies do? See, company will make a profit and loss account, okay, as for the AGM purposes, as per the Companies Act. Okay. Now, what will the companies do? Companies make a profit and loss account for the MET purposes, as per Income Tax Act. Companies will make two profit and loss accounts from now on. If the government want to take the AG, the government want to charge the profit at the rate of MET of the AGM books of accounts, so they should write that clearly. Otherwise, the companies will start making another profit and loss account for the MET purposes. As you have already studied in the audit, there are also some special financial statements, special purpose financial statement that are made for special purposes only. Okay, so the government, as the Companies Act does not uh, restrict to make these type of profits and loss account, so the companies will start making the profit and loss account for the MET purposes only. So then the purpose of the government will also defeat. So the government has written the accounting policies, accounting standards, methods, and rate for depreciation. Everything. Now you can understand why these words are written. The depreciation rate for the depreciation, method for the depreciation. Okay, this is the main objective of the government. Should be the same. Should be the same. The SLM WDV should be the same. If you are following as on WDV here for the Income Tax Act, then you have also to you are in the Companies Act profit and loss account, the method of depreciation should be the same as have been adopted or for statement of the profit or loss of AGM. The government clearly said what we have presented in the AGM should be shown to us for the income tax purposes. Okay. Now, what are the types of financial statement? Every company is not registered under the Companies Act. Some companies are regulated by some other special acts like the banking company, insurance company, electricity company. Okay. So for that, whatever their regulatory authority said, this is the pro forma to prepare a profit and loss account, balance sheet, or this or this should be the pro forma of your financial statement. Then the financial statement of these type of companies must be prepared with the respective regulatory act. But in the any other cases, the financial statement must be prepared as per the Companies Act. Is this clear to you all? In company, in case of company which governs from the special act like banking company, insurance company, or electricity company, it must be prepared. The profit and loss as per the PNL must be prepared as per the regulatory act, or in any other cases must be prepared as per the Companies Act. And if you are preparing any type of a statement of the profit and loss, it should be the same which you have presented in the AGM. This is the whole objective why the government brings the minimum alternative tax into picture. Is this clear? The whole story which I have explained you here in the very starting is the main base why the alternative tax, which is minimum the government want to take, why it comes into picture. Is this clear to you all? Now, let us start with the book profits. Now, we have taken the base. The net profit which is given in the AGM books of accounts need to be taken care of, need to be the base. Okay, so we have kept it here. Now, in this, we have to add something, and in that, from that, we have to subtract something. So now we are going to start with the series of addition and subtraction. Will not start with only add and complete first add and then start with less. We'll do simultaneously as some points are common in this add and the less. Okay, so why these are interrelated? I just want to clarify this that thing. So we'll take up both simultaneously, the add provisions as well and the less provisions as well. Okay, so the first provision, the income tax, whether paid, payable, or provision thereof, including interest charged under the Income Tax Act, surcharge and cess. The government is saying that we are calculating the income, the profit for the income tax only. So the income tax charged in your books of accounts, either by the name of the paid, payable, provision thereof, does not make any sense. We are calculating income tax for your business for this assessment year. So the income tax charged in your books of account, which is already debited to your profit and loss account, should be reduced, should be added back in your profit and loss account, so that we could reach to the main books profit. Is this here? The government objective to add this provision was we are calculating the book profit for the income tax purposes only. So the income tax which are already debited in your books of accounts need to be ignored, need to be cancelled off, and need to be added back to your book profit, which is already reducing your book profit, the net profit. We just need to add it back and reach at the correct profit. Is this clear? So income tax with whatever name called paid, payable, provision. If you made the provision, then it also to be added back. If it is payable, that it is shown as the income tax payable, then it also be added. If it shows the income tax paid, then it also be added. If the company said now what the company will do, the income tax portion showed differently, the surcharge portion showed separately, the cess portion showed separately. The income tax will only disallow the income tax portion. So the government wrote including interest under Income Tax Act, surcharge and cess. The whole income tax, including surcharge, cess, interest, all everything needs to be added back to the profit and loss account, the net profit. Is this clear? Why this provision came? This provision came because we are already calculating the income tax act. We are already calculating the tax based on the book profit. So the income tax already debited to the P&L will not make any sense here. So it should be added back. First thing clear. Now coming on the second point. Okay, so the first point is clear why the income tax has been added back. Okay, now coming to the second point. Second point is deferred tax. Deferred tax. See, the deferred tax is just made for the timing difference as per the Companies Act, because of the Companies Act, or you made as per the income tax, sorry, for the Ind AS 12. But under the Income Tax Act, there is no provision for the deferred tax. You have made the deferred tax asset or the provision for deferred tax by whatever name called. If it is reduced from, it is debited from your P&L, now you have to add it back. It is okay because it is just mere for the timing difference, no use of that deferred tax. It is just reducing a profit. So the government does not want to include that deferred tax asset in your profit and loss account. So they just wanted to reduce that from your from the net profit, so that it should be added back to the net profit, so that the government should reach to the correct net profit. It is just mere for the timing difference because of the Companies Act or as per the Ind AS 12, but it does not have any significance to the Income Tax Act. So this needs to be added back. The deferred tax asset needs to be added back. So the simultaneously the deferred tax liability should be reduced from the net profit as well. So the government also gives the point from the less that the deferred tax liability which are credited to the statement of P&L should be reduced. Is this clear? The provision for the deferred tax is also clear. Clear. Now the third point. See, what is the original problem? The government said the profit is higher, they are giving the higher dividends. The higher dividends are debited in the profit and loss account, which eventually reduce the profit for the company. The main concern was that. So the government now said the dividend paid or the dividend proposed by whatever name called, paid or proposed, if it's related to the equity, preference, or a special equity, by whatever name called, if the dividend is debited in the profit and loss account, we are not going to allow that. You have to add it back, as you can show the higher profits or give the higher dividends. By giving the higher dividends, the income tax portion, the net profit for the income tax will also reduce, so we are going to get the less tax. So the government does not want to reduce their tax revenues. That's why the government said the dividend paid or proposed need to be added back to the profit and loss account. This need not to be let it down, reduce our net profit for the income tax purposes. Is this point clear? The first point, second point, third point, and the point of less is second point. All these 4 points are clear to you? Clear. Okay. If you have any problem, then you can write it down in the chat box. Chat box. I'm available there on as well. So the doubts will eventually get solved simultaneously. If you have any doubt, I'm available in the chat box, chat section, the live chat section. You can ask me doubts there. Is this clear to you all? Clear. Now, the fourth point, amount transferred to any reserve, whether general, statutory, or made as per the provisions of RBI. See, what will happen? The companies will what do? They have not allowed income tax. They have not allowed deferred tax. They have not allowed the dividend proposed or paid. So, what will companies do to reduce their net profit? Company will say, our net profit is 200 crore. So, just reduce it to 10 crores and transfer the balance 190 crore to general reserve. The company can do so. They can make the reserve from the profit and loss portion. So the company are reducing their profit and transferring the maximum portion of their profit to the general reserve. The government noticed that. The government said, this is mere loss of our profit. loss of a tax revenue. So government does not want that. Government said this is wrong. You have to add it back. Uh, If we allow that, then one day will come that you say no. Our profit is 0 crores. We have transferred all 200 crores to the general reserve or statutory reserve or any type of reserve which are allowed by the RBI, which are need to be made because of the RBI guidelines or the IRDA guidelines. So this will definitely going to hamper the revenue of the government. So the government said any amount transferred to any reserve needs to be added back. The profit and loss account needs is debited because the amount is transferred to the to the general reserve. So the government said it needs to be added back because you'll do some you'll be if we allow this to you, then you'll reduce your profit and show all the profits in the general reserve. Is this clear to you all? This is the point. This is the reason why government added the income, added the reserve, if any debited to the P&L. Is this clear? The 4 points is clear. Now, coming on the fifth point. Fifth point is saying provision for unascertained liability. See what is saying? Unascertained liability. The liability which is unascertained means if in Hindi we say it manmani. The company is making the provision for the liability which is not known to them. They are just making on their own assumptions that this liability may arise. This liability may arise to us. The provision for unascertained liabilities they are making, and because of that provision portion, the net profit in the AGM is reducing. So the government said this is not acceptable to us. So any provision which is for the unascertained liability is what? Which is money, which is not known to to the company as well. They are just made on the ad hoc basis. What is the ad hoc basis like? They made the provision for contingency or the provision for the gratuity on the ad hoc basis. Not they did not do any type of calculation, any sort of calculation. They did not apply any method. They just on their basis of assumption just debited the provision for the contingency or the provision of the gratuity in their books of account. That eventually reduces the net profit for the government. So the government does not want to reduce their tax revenue. That's why they just said just to add it back to the books of accounts, to the profit and loss account. Is this clear to you? But now the government only wants to plug the unascertained liability. But what if there is a provision for ascertained liability? Then the government said it should not be treated as to add back. It should not be added back to the profit and loss account. It is a ascertained liability. It is based on some calculation, the statistical method or the scientific method. So we are not reducing it. We are accepting that this is your liability. So keep them debiting in your books of account. If it is based on any scientific or statistical method or any rational method which is going to be ascertained that this liability needs to be paid by you, so you can eventually debit that from your books of accounts. The government is not saying anything to you on that. The government is only plugging what? The unascertained liability, not the ascertained liability. Is this clear? The provision for ascertained liability, the important note is the provision for ascertained liability, like the provision for gratuity on actuarial basis or provision for leave encashment, warranty, etc., made on the scientific or rational basis will not be added back. Okay, if the actuary is the actuary has done the valuation based on the scientific or rational basis or a statistical method, so that will be allowed to keep debit in your books of accounts, but not for the unascertained liability that you have debited on an ad hoc basis. Is this clear to you all? Now, coming on point number 6. We have completed point number 5 till point number 5. Now we are coming to the point number 6. Point number 6. The provision for diminution in the value of asset. We have taken care here the liabilities. Now if the provision for unascertained liability, if you have any debit, if you have debited any certain unascertained liability in the profit and loss account, that needs to be added back. So this is for the liability. The government said the same thing you are doing for the asset as well. How the same thing is happened if for the asset as well? The company are doing. Now we can't do anything for the unascertained liability, that will be added back. So the company thought of idea that now, instead of debiting for the provision for any liability on ad hoc basis, just debtors on them. The provision for doubtful debtors. They can make so on the assumption basis, because the doubtful debt is always are on assumption basis of the management. What management thinks, what management expect that this will be the doubtful debt. So they can do the provision. They can do the provisioning of that. So the same things were happening. The government stopped for the liability. So the company started for the assets. They are reducing the provision for the provision for bad debt, the provision for doubtful debts on the ad hoc basis with only assumptions. So the government said it is also a assumption. We are not going to entertain this. Just add it back to the statement of P&L. We are not going to take, we are not going to give any type of deduction for this. So the government also said from liability, they are now coming to the asset. The screen. Now see. Provision for diminution in value of any asset, like provision for bad debt, provision for AS 13, the investment, AS 28. It may be noted that the actual amount of bad debt as debited will not be added back. Actual amount will not be added back. Only the provision which you have made on an ad hoc basis will be added back. The actual amount which will be not added back. Is this clear to you all? Clear. So let's come on to the seventh point. For the seventh point onwards, we'll have to make a copy, and so you have to take out your copies and the pen and just write it down with me. Suppose it is a XYZ Limited, a subsidiary. It is a VV Limited. Just a second. It's a VV Limited. It's a holding company. Okay. Now, in the financials of a VV Limited, there is a profit of 200 CR. Okay. But in the subsidiaries PNL, in the subsidiary XYZ Limited PNL, there is a loss of 100 CR. Is this clear? Now, what has done? For the purpose of consolidated financial statement, the VV Limited had to make a consolidated financial statements. So for the purpose of the consolidated financial statement, what has happened? We have consolidated the loss of 100 crore from XYZ Limited in our financials. So what the entry will be? Here I made a loss of subsidiary of 100 CR. Now my profit will reduce to 100 CR because of this loss of the subsidiary. The company used to do this. They used to acquire they used to make a small company which are undertaking the losses just to set off their net profit from the losses of those subsidiary and to give the tax on the remaining profit of their entity. The companies are planning these type of ways, so the government just noticed that and said this is not going to happen from now on. We are disallowing this loss. Okay, so any loss which reduces your profit, loss of a subsidiary that reduces your profit. Just a second. Loss 100 CR. So that reduces your losses of 100 CR. That's why the government just wanted to add it back. That reduced 100 CR, the reduced 100 CR balance due to the loss of the subsidiary need not to be added back. So need to be added back in your accounts. So the government said under the point number 7, the losses including the provision thereof of the subsidiary company needs to be added back to the P&L uh, of the parent company. Is this clear to you all? The losses, why this has happened? Because the government noticed that the companies are tax planning from this provision, and they are acquiring the companies which are making loss and set off their losses through the profits of their own. So to reduce the net profit on which the government wants to take tax. So just to avoid this tax evasion, just to avoid the the impact on the tax revenue, the government said the loss of the subsidiary which you are setting off in your P&L because of the consolidated financial statements, you just not need to take just you just not need to carry forward. You just not need to set off that. You just have to add it back to the financial statement. Is this clear? Clear the point number 7. Now, coming on to the point number 8. Expenditure related to the income exempt under section 10, 11, 12. Suppose there is an income which we are earning from the section number 10, from section number 11, or from section number 12. From section number 11 or 12, what these are the income exempt for the charitable trust. And for from the section 10, you know, all the exempt income for other than charitable trust are coming under section 10. Is this clear? If the company is having the agriculture income, suppose the company is having the agriculture of rupees 100 CR, or the expenditure incurred in relation to that agriculture income comes to 60 CR. So the impact in the book profit is of 40 CR, which is adding to the net profit. Is this clear to you all? 100 CR is the income, expenditure is 60 CR, so the net profit increased by 40 CR. The government is saying that no, we will not allow this. Just add it back. The expenditure which you are incurring because of the section 10 income, which is exempt as per the income tax act, but the income tax act is overridden by section 115 JB, so we are not following this income tax act, so you have to add it back, the expenditure which you have incurred. So if you are adding back our expenditure, you have to reduce our income as well. This is what should be done. If you are adding back the expenditure relating to sub income, then the income should also be reduced from the net profit. So take it the nil effect. The net profit effect should be nil here. The government said the same. Expenditure relates to the income exempt under section 10, 11, 12 should be added back, and the corresponding effect has been given under the last section, that the income which is exempt under the section 10, 11, 12 shall also be reduced from the credited P&L. Is this clear? Now, coming on to the point that section 10 is if suppose there is section 10 AA, this includes under section 10, or it is a separate section? It is a separate section. It does not include under section 10. 10 10 2A is a section which includes under section 10. 10(1), the agriculture income. 10(2), these all are the sections which are of section 10. Section 10 AA is a separate section. So the government said it for only section 10. If there is an income of section 10 AA credited to your P&L, you will not going to reduce the expenditure, the income of that section 10 AA, and should not be added back the expenditure of such income. Is this clear? So section 10 11 and 12 are only allowed to be added back, and the expenditure to be subtracted. The expenditure should be added and the income should be subtracted. But for the income under section 10AA, this treatment is not applicable. Is this clear? Income covered under section 10AA under section chapter 6A, section 80 shall not be reduced. Is this clear? It shall not be reduced. Now coming on to the point number 9. Point number 9 says expenditure related to income, that is a member share in AOP, in the income of AOP BOI, which is exempt under section 86. Now what is under section 86? Now coming on to the point number, onto the board notes and making notes. See, suppose there is a AOP. Say XYZ is a AOP. Okay, XYZ is a AOP. Now it's my company VV Limited. VV Limited invested in AOP and they have given us the dividend. Is this clear to you? They have invested and they have we have invested and they have given the dividend to us. Now, if you study the AOP chapter, they say the AOP income will be taxable at the rate of maximum marginal rate if the member of AOP, if any member of the AOP income, the total income exceeds the basic exemption limit. What it says? The income of AOP shall be subject to tax at maximum marginal rate if any member income exceeds the basic exemption limit. Now, if you can recall, the basic exemption limit for a company is nil. Either they earn 10,000, they earn 20,000, they have to give the tax as per the applicable rates. So any income earned by the company is always greater than the basic exemption limit. So eventually the member VB Limited has the income above than the basic exemption limit. So the AOP gets taxed at MMR. Is this clear? The AOP shall be taxed at MMR. And then under section 86 says that if AOP taxed at MMR, then the income under the hands of VV Limited, the member, shall be exempt. Shall be exempt. So what it says, if the AOP is taxed at the maximum marginal rate, then the income earned from that AOP by the member's income share will be exempt under section 86. So the government, so what we are saying to the government, as you have given the treatment for the exempt income, section 10, 11, 12, the income is also exempt under section 86. So give the same treatment as you have given to the section 10, 11, 12, the exempt income to make it at a parity. So just to make it at a parity, the government also included the section 86 exempt income here as well. The treatment shall be the same. See, the expenditure relate to the income of the member share in the in the income of AOP BOI, which is exempt under section 86, shall be added back. And now the corresponding effect has been given that the income, that is the member share in AOP BOI, which is exempt under section 86, shall be reduced from the PN. Is this clear? The logic of each and every point is clear to you. You'll not be able to recall when you have not understood the concept very clearly. So just try to understand the concepts clearly, the logic behind the provisions which is kept by the government. If you understood all those points, you will definitely going to remember each and every point without even cramming these points. Is that clear to you? If you have any doubts, I'm available in the live chat section. You can ask me there itself in the real time basis. Okay. Now, coming on to the point number 10. Now, point number 10, what it says, point number 10. See, point number 10. And corresponding the simultaneously effect is given under section under point 5. And here it is point 4. Point 4 of less. Okay, the point 10 and point 5. What it says? Just a second. Yeah. Point number 10. Suppose under the non-resident taxation chapter, the government wanted to attract the non-resident to India as they come with the foreign currency reserves. As the foreign resident come and invest in India, the government will get the foreign currency as because of that the foreign currency reserve will increase. So the government wanted the more investment from the non-resident. So to attract those non-residents, the government give the concessional tax rate on their incomes. Like if the non-resident earn the income from the interest, they have just kept the rate of 4%, 5%, or 9% in the different cases. We'll all study these cases under the chapter non-resident. Okay. Now, if we see the capital gain on securities, the tax are taxed at the rate of 10%. Okay. If we see the dividend income, these are also taxed at the rate of 10% for the non-resident taxation. So the government want to give the benefit to these non-resident. If we are going and charge the MET, we apply the MET at the rate of 15% to them, then what is the benefit of giving these lesser tax rates, the concessional tax rates? So the government said, if the concessional tax rate given to the non-resident is less than the MET rate of 15%, then the concessional tax rate will be applicable and the MET will not be applicable. So the expenditure relating to that income earned by the non-resident shall be added back to the profit and loss account, and the corresponding effect should be given to the income. So it is a reversal entry. Is this clear to you all? Just to give the concessional rate tax rate benefit so that the non-resident keeps on attracting to come India and invest thereon. So this is why the governments excluded the income and expenditure from the PNL of the non-resident entities. Okay, is this clear? So come here. Expenditure incurred by the foreign company having the DTAA plus P. Because if any of these conditions goes wrong, either DTAA is not entered or the P is not happening, so the MET will not apply. MET will only apply if you have a DTAA plus P. Okay, on earning of capital gain relating to securities, dividend, interest, royalty, or fees for technical services, if otherwise applicable rate, that is the 4%, 5%, 9% on such income is less than the MAT rate. If this is the case, when where the applicable rate is less than the MAT rate, so this is going to be the treatment. But suppose if the applicable tax rate is 20% and the MAT tax rate is 15% only. So whether this provision will apply? No, this provision will not apply. The income will be added back. The income will be added as it is added in the books of accounts, and the expenditure will be debited as debited in the expenditure in the P&L account. No such treatment will be applicable in case where the applicable tax rate and of the otherwise applicable tax rate is greater than the MAT tax rate. This is only applicable. This treatment is only applicable when the applicable tax rate on the non-resident is less than the MAT rate, just to give the benefit to those non-resident. Is it okay? Just to attract those non-resident to India, this provision has came into play. Okay, so point number 10 is clear. Now correspondingly, the same effect has been given under section point 5. The income has been reduced. Okay, the same point. The otherwise applicable rate is less than the MAT rate. Foreign companies, securities, dividend interest, royalty, fees for technical services. Is this okay? All points are clear till now. Now, coming to the section point number 11. Then we have point number 12, then this additional point. Then we have small points. Apart from this, everything is very easy. It's going to be very easy. Then our chapter will be over very soon. Coming on to the expenditure related to royalty income from patent, which is taxable at the concessional rate at under section 115 BBF. Under section 115 BBF, the tax rate is only 10%. Why it is happening? Just I am letting you know under the board notes. See, point number 11 of addition and point number 6 of less. Okay. So now understand what is section 115 BBF says. Suppose I am a VB Limited. I have done some research and development. I have done some research and development in India for some patent. Okay. Now I saw that if I register the patent in India, the whole income from that patent will be taxable in India. Okay. And the tax rate at India is very high. So I just wanted to shift in such kind of country where the tax rate are minimum or no. The nil tax rate is applicable or the minimum tax rates are applicable. So I found one country, that is Mauritius. Okay, that is Mauritius. Now, after completing the research and development, I just went to the Mauritius and registered my patent there. Okay, now every income arising from that patent will be taxable in Mauritius as the patent is registered there. So, at what rate I am taxing? Either at the rate of 0% or some minimum or negligible rate. Okay, this is the benefit. But the Indian government does not want that. The government said you have done the research here. The government says the research and development expenditure are incurred in our country. But when the time comes to register that patent, you go to the another country, and because of that tax benefit, you just switch in the country of registration to the patent. So the income that should be earned by us from your patent is earned by some other country, and the expenditure relationship and the expenditure on those research and development has been incurred in our country. So this is the problem. The government wanted that if the research and development happened in our country, so the patent should also get registered in our country itself. So just because of that benefit, because of that tax rate benefit, the government does not let the individuals or the companies go and register their patent in some tax haven countries. So the government reduced the tax rate on that patent income, the royalty income from that patent, to at the rate of 10% itself. It is a concessional tax rate. The government want to attract these type of people who do research and development in India and settle out some and they register their patent in some other country because of the tax rates. So the government reduced the tax rate to the 10%. Now suppose the tax rate is 10%. Now, if we say the 15% MAT is applicable to you, whether they are going to stay in our country? No, they will again move to the Mauritius now. Okay, understood. That's why the government said, okay, 15% MAT will not be applicable on this type of income. We are reducing the effect of this on the MAT income. So, what it says, the expenditure related to the royalty income from the patent which is taxable at the concessional rate under section 115 BPF to be added back, and the corresponding effect should be given under the royalty income from patent which is chargeable to tax at the concessional rate of 10% under section 115 BPF. Is this clear to you all or not? Now we are coming to the most important point, the depreciation adjustment. There is total three adjustments relating to the depreciation. First is point number 12, then point number 7 and point number 8. These all three adjustments run simultaneously and we need to understand them simultaneously and correspondingly. Is this clear to you all? After that, we'll left with one addition, one subtraction, and point number 9, point number 10. After that, every point of addition and subtraction will be completed. After that, only the remarks and the other provisions, which are very easy, will be left only. Is this clear to you all? Okay. Now coming to the point number 12. Point number 12 is the depreciation point. Point 12 of addition oblique point 7 and 8 of less. Now understand the situation. What is the situation? See, suppose for the assessment year 24-25, I have a plant or machinery whose value is 100 CR. Okay. At the rate of 15%, the depreciation should be available on this. Okay. So the actual amount should be 15 CR of the depreciation. But what I did an revaluation of plant and machinery to rupees 150 CR. Then charge the depreciation at the rate of 15%, which comes to rupees 22.5 CR. Now, what I have done the excess depreciation of 7.5 CR because of the revaluation of 50 CR. From 100 CR to 150 CR, we have done the revaluation of 50 crore rupees, and on that 50 crore rupees at the rate of 15%, the excess depreciation that we have charged is of rupees 7.5 CR. Now the government is claiming that this is the excess depreciation that should not be allowed to you, as the original depreciation should only be 15 crores. To reduce your net profit by debiting the excess depreciation in your profit and loss account, you are showing the excess depreciation so that you can charge the excess depreciation in your account, so that we can get the less profit, less net profit, and we can get the less tax amount. Is this clear to you? So the government does not want that. The government is claiming that the excess depreciation of 7.5 crore rupees that you have charged because of the revaluation. What is the revaluation profit? That is the revaluation. The excess depreciation due to revaluation was 50 CR, 150 CR minus 100 CR multiply by 15% is equal to 7.5 CR. That is the excess depreciation the government wants us to just add it back to the net profit. So instead of adding it the 7.5 crores directly to the net profit, government said one thing. Government said what you have debited, what you have actually debited to the books of account should be added back. What we have to enter? The actual amount that was debited to the PNL. The actual amount that was debited to the PNL was 22.5 CR. At the final, after the revaluation, this amount was debited in the this amount was showing in the PNL account. So we have to add this back. Depreciation showing in profit and loss account. Okay, is equal to 7.5 CR. Sorry, 22.5 CR. Now we have to reduce. What we have to reduce? The actual depreciation should be charged to the PNL. What is the excess depreciation? That what is the actual depreciation that should be charged to the PNL is 15 CR. Understood? It's 15 CR only. So depreciation excluding revaluation reserve. Okay, that should be 15 CR. So by effect, 7.5 CR is already is now added to the net profit. Is this clear? Is this clear? Understood? So, that's how the government is trying to add the depreciation, the excess depreciation charge in the PNL account in your net profit. The excess depreciation was 7.5 crores, so the government just want that 7.5 crores added to your net profit. Is this clear? Just see here. The point number 12. What does the point number 12 says? Depreciation in totality as debited to the profit or loss. In totality, was what was the total income? Total depreciation 22.5 CR. Okay. Now, depreciation debited, we are under the less. The depreciation debited excluding relating to revaluation component, excluding the revaluation component was 7.5 CR. If we have to exclude it, then 20 point no 22.5 CR minus 7.5 CR is equal to 15 CR. So what we have to less? The 15 CR. The two adjustments of depreciation is clear to you all? Clear? Now we are moving ahead for the third adjustment. Now see, this is the case of a company who are malifying. This is a malified case where I am trying to revalue my revalue my plant and machinery just for reducing my net profit. This is the malified case. But there may be some cases where the intention of company is not to reduce the net profit, but in the rare circumstances there may be situation that the actual value of the plant and machinery has been revalued. Actually they have revalued, so the government does not want to add that excess depreciation charge in the books of accounts in the case where the depreciation, the revaluation has actually been happened. So what is the case now? See, now it is a proper case, not a malified case. So when a proper person the revaluation has done what he has done. Okay, see, profit or loss account. A person charged depreciation on 150 CR multiplied by 15% is equal to 22.5 CR. This is the case. But now understand what did the company did. The company said the excess depreciation of 7.5 CR that we have charged, takes it from the revaluation reserve and charged it to the PNL and increase your PNL by crediting the excess depreciation amount from the revaluation reserve. So the company said the amount withdrawn from revaluation reserve, how much? 7.5 CR. So see here the net depreciation charge to the PNL went to 15 CR only. That was the actual PNL that to be charged in the PNL. Actual depreciation that to be charged in the PNL. Is this clear to you? So this is the actual depreciation charged to the PNL. This is the case where there is no malified intention of the company. So the government does not want to add back these the 7.5 crores in the net profit. So here the government is saying that in the case where there is original case, where there's no intention of malified, so we will reduce the amount transferred, amount withdrawn from revaluation reserve 7.5 CR, but the government restricted it to 7.5 CR only, the excess depreciation. It is restricted to the excess depreciation only. Okay, just to nullify the effect of the addition done in the net profit. Suppose a company transferred 9 CR in, from the revaluation reserve, so the depreciation will not be of the 9 CR. Depreciation will not be of the 9 CR. The depreciation will only be available to the amount of excess depreciation, that is 7.5 CR only. Is this clear to you? All three adjustment, why it is added, why it is subtracted, and why it is subtracted, all these 3 points are clear to you. Just read it from the notes as well. Amount withdrawn from the revaluation reserve, that is 7.5 CR, to the extent of the depreciation relating to the revaluation component, that is the excess depreciation. The excess depreciation that you have charged, the 7.5 crores depreciation that you have charged, the excess charge to the PNL shall be less from the net profit. Just to nullify the effect of these two above two entries, the point number 12 and the point number 7 of the less. Is this clear to you all? Clear? Now, we have completed the major portion of the add, and we have now having the last point of addition, that is the amount standing in the revaluation reserve on retirement disposed of such revalued asset if not credited to the PNL. Now understanding this, okay? So for that I just need to take this to my notes. Just wait for a second. Last point, last point of addition. Okay, now understanding this point. While understanding this point, I just need your attention. The full attention, I just need your. Okay? Now understanding it very carefully. Suppose what happened for the assessment year 24-25. Okay? I have a building for suppose 10 CR. Okay? I have transferred it and the sale consideration received was suppose 100 CR. So I was supposed to give the capital gain taxation at the rate of 90 at on the amount 90 CR. Is this clear? The 90 CR should be the net profit that should be added in a net profit. Okay. The 90 CR profit should be added in the net profit amount. But to reduce the net profit and to pay less tax on it, I just did one thing. Just before the sale consideration, just before the transfer of that building, I revalued the building and converted it to 99 CR by revaluing plus 89 CR. By revaluing it to by rupees 89 CR. The final value will be 99 CR. So now when the government will come and ask for the addition, the net profit will say, okay, this is the only net profit. The 1 CR is the net profit. You can add it to the books of accounts and take tax at the rate of 15% from it. But the government noticed that they just before the transfer revalued the building. Just before the transfer, they revalued the building by 89 CR. They substantially revaluated the building just to reduce the net profit, so that they could not they can get the tax deduction. They can get the lower net profit. Okay, so this was the case. So the government said that what entry you have passed in your books of accounts, the entry we have passed was asset account debit to revaluation reserve of 89 CR. Government said just reverse this entry and take this revaluation reserve to the P&L account. Credit this revaluation reserve to the P&L account. But we are not doing so. So the government said, okay, if you are not doing so, so whatever is your profit that you are showing, that is 1 CR. We will add it back 89 CR in your net profit, and the final figure will be the 90 CR on which we will get the net profit and we will get the tax here. So the government is doing what? They are adding back the revaluation reserve that we have transferred. Okay, that we have shifted our gain, the net profit, to the revaluation reserve. So the government is now taking it back to the P&L account. Is this clear? So just read it once. What it says: amount standing in the revaluation reserve on retirement or disposed of such revalued asset, if not credited to the P&L account. If the revaluation reserve amount is not credited back to the P&L, then this addition will be done. Is this clear? This addition of 89 CR will be done to make it 90 CR. Which was the actual net profit? 10 crore, 100 crore minus 10 crore is equal to 90 crore, which was the actual net profit. Is this clear why the government has to take this point in the addition? So now with this we have completed all the points of the addition. First, just let you revise this, all 12 or 13 points. First is the income tax, second deferred tax, third the dividend paid or proposed, fourth amount transferred to any reserve, fifth provision for the unascertained liabilities, sixth provision for diminution in the value of assets, sixth losses or including provision thereof of subsidiary company. Eighth, what is it? Expenditure related to section 10, 11 or 12 in corresponding with to bring the parity. The 80 under point number 9, the expenditure related to the income, that is the member's share in the firm in the income of AOP BOI, which is exempt under section 86, has also been included under the point number 9. Now for the point number 10, the foreign companies who have a DTAA plus permanent establishment in India, the expenditure shall be disallowed. The expenditure shall be disallowed for the capital gain relating to the securities, dividend, interest, okay, royalty or fees for technical services, if the otherwise applicable rate is less than the MAT rate. If the otherwise applicable rate is greater than the MAT rate, then the MAT will apply. Is this clear? That is clear to you? Now, the point number 11, the expenditure related to the royalty income from patent, which is taxable at the concessional rate under section 115 BPF. And what is the concessional rate there? The concessional rate is 10%. Then the depreciation entry, just we have covered, and amount standing in the revaluation reserve on retirement or disposed of such revalued asset, if not credited to the statement of P&L. Is this all clear to you? Clear? No. For the last point, just keep pending first point. No, just we are revising the points we have done. First is a deferred tax. Second is the income which is exempt under section 10, 11, 12. Then the income will not include the section number 10 double A income. Then fourth point is income of member share in AOP BOI which is exempt under section 86. Then income of the foreign company. The expenditure was disallowed above, so the income is also disallowed in the as point number 5. Then sixth is the royalty income from patent. Seventh is the depreciation, and this eighth is also the depreciation amount withdrawn from the revaluation reserve. The three addition or less is related to the only depreciation. Is this clear to you? These last 2 points are very easy, but before that, we will complete the first point of the less. Amount withdrawn from any reserve provided book profit was increased by the amount transferred to such reserve in the year of creation of such reserve. Now, coming to the board notes. I hope you all are preparing these board notes with me. If you are not, so please be serious and prepare it by yourself. Okay? Point one of less. Now, what it says, suppose a situation, see, this is a previous year 2021. Okay, now in this previous year, suppose I have transferred to general reserve. Say the amount is 20 CR. Okay, and then there is a net profit which comes to something. Okay, while computing the MET calculation of the year previous year 2021, what we have done under the MET, because of the point 4 of the addition, what we have done, net profit add amount transferred to any reserve. The amount transferred to any reserve is added back according to the point 4. Okay, amount transferred to general reserve shall be added back. We added back here 20 CR. Now this comes to any MET profit, MET book profit, on which we have to give the tax at the rate of 15% plus surcharge plus cess. Okay, this was the case in the year of 2021. Now coming to our year, the previous year 23-24. Okay, what has happened? Suppose I am preparing the PNL for this amount for this year. Here is my net profit. The amount transferred to general reserve in the year 2021 is now withdrawn in the year 23-24. The withdrawn amount is credited to my P&L account. Okay, so the amount withdrawn from general reserve 20 CR. Now, what is the problem? See, this 20 CR amount is included in the net profit. So, what I am asking to the government is, see, you have taken the 20, you have taken the tax on 20 CR in the previous year 2021 of because of the MET provision. Now you are also taking the tax on the 20 CR in the year 23-24 because the amount is included in the net profit. So you are taking the tax on the 20 CR twice. You are taxing the same income twice in my hand, that you are making a double taxation. Is this clear? So the government did not intended for the double taxation. So now here what the government said, when you compute the MET provision, when you compute the book profit as per MET, so net profit, take the net profit and reduce the amount withdrawn from general reserve 20 CR that we need to reduce. Then it comes to the book profit based on the MET, and on which 15% plus surcharge plus health and education set shall be paid. Okay, so this is the dual entry. Once the government has taken the tax here, now the government is reducing the same amount here. Suppose What government said? Government said with this and this with the condition. What is the condition? Government said this amount shall only be reduced in the previous year, in the year 23-24, when the said amount is 20 CR, is added to the reserve, is added to the profit or loss account, is added to the book profit in the year of creation of such reserve. The year of creation of such reserve was 2021. So whether it is added, this is the main condition. Is it added in the net profit? Yes, it was added in the net profit in the year 2021. So it's okay. It is, if it is added, then you can reduce it. Is this okay? If you have added 20 crore, then you can take the deduction. If you have not added 20 crore in the year of creation of such reserve, then you will not get deduction of this amount. Is this clear? Now, I'll read this. Amount withdrawn from any reserve provided book profit was increased by the amount transferred to such reserve in the year of creation of such reserve. Is this clear to you all? Now we have completed each point. Just 2 points are left of the less portion. Okay. Now coming on to the less portion, what it says? It says we will allow the deduction from the net profit of the brought forward loss or unabsorbed depreciation, whichever is less. We will not give the deduction of both the things, brought forward loss or unabsorbed depreciation. We will allow only one, whichever is less. Is this clear to you? What it says? Brought forward loss or unabsorbed depreciation, whichever is less as per the books of account, not as per the ITA. The books of account as per the Companies Act, whichever is less, brought forward loss or the unabsorbed depreciation, whichever is less, shall be allowed as a deduction from the net profit. Is this clear? The point number 9 is clear. The point number 9 comes with two exceptions. The exceptions was where the aggregate amount of the brought forward loss or the unabsorbed depreciation shall be allowed as deduction. What are these two exceptions? First exception is the company went into the CIRP process under the Insolvency Bankruptcy Code of 2016. What is the CIRP process? CIRP process is the Corporate Insolvency Resolution Process. Okay, if the company went into the IBC code 2016, the benefit of brought forward losses and the unabsorbed depreciation, the aggregate amount can be reduced from the net profit. This is the first exception. Second exception was on the recommendation of the CG, the NCLT has removed the board of directors of the company and appointed a new directors in the board of the company. On the application of the central government, the NCLT has exercised its power and suspended the board of accounts board of directors of such company and has appointed new directors who are nominated by the central government. Is this clear to you all? These are the two exceptions. In these cases, you will get the deduction of both brought forward losses and the unabsorbed depreciation. Okay, see, in the following cases, aggregate amount of brought forward loss or unabsorbed depreciation shall be allowed as deduction in computing the book profit. What are these 2 points? In case of the company against whom application for CIRP, the corporate insolvency process under the Insolvency Bankruptcy Code 2016 has been admitted by the educating authority, that is NCLT. Okay, now point number B. In case of a company and its subsidiary and the subsidiary of such subsidiary, that is the case A, B, and C. Subsidiary of such subsidiary. Okay, where the National Company Law Tribunal, on an application moved by the central government under Section 241 of the Companies Act 2013, has suspended the board of directors of such company, and both the conditions should be fulfilled. First, the board of directors has been suspended and has appointed the new directors who are nominated by the central government under Section 242 of the said Act. Is this clear to you? In these two situations, the aggregate amount of deduction shall be taken care of. Is this clear to you all? Clear. Now, coming to the point number 10. What is the point number 10? Point number 10 is introduced to give the benefit of the sick industrial to the sick industrial company. The government wants the revival of the sick industrial company, so they come up with the 10th point. They said the profit portion will not become the part of the MET. If whatever you have added or less, the added and subtraction that we have studied, these portion will become the part of the MET. But while computing the MET portion, while computing the book profit, you will reduce the profit earned. See, what is the case? Suppose the company earned 10 crore this year. After adding or subtracting, there becomes the addition of 15 CR. Okay, now the government said this is the book profit that you need on which you need to give the tax. We are reducing the actual profit that you have earned, that is the 10 crore rupees, just to give you a benefit that you can revival early. Okay, so this is the case. We will reduce the profit only the 15 crore on which you will give the MAT at the rate of 15%. Is this point clear to you all? Understood? So what it says, profit of a sick industrial company will be reduced. What is a sick industrial company? Where the net worth of the company is less than the accumulated losses. Okay, where the net worth of the company is less than the accumulated losses. So till when this deduction will be applicable? It is available up to the previous year in which net worth becomes equal to or greater than the net profit. If the net worth becomes greater than and equal to the accumulated losses, so now it is not a sick company. Therefore, the exemption will only be available up to the previous year in which the net worth goes equal or greater than the accumulated losses. These are all points of addition and the subtraction. I hope these 2.5 pages are very clear to you all. Is this clear? These first page is very clear. It is a basic page. Second page, we have done every point in detail for the addition, and we have also done every point of less in the details. Now we are coming to the remarks portion. What are the remarks portion? See, what we have understood here is the book profit shall be deemed to be the total income. If we are saying it is a total income, we are saying it is not a gross total income. So the deduction under section chapter 6A under chapter 6A will not be allowed. We have not mentioned any type of exemptions of capital gain, section 54 to 54 GB. They are also not allowed. So this is the important remark they have given here. See, it may be additionally be noted here that no exemption under section 54 to 54 GB or deduction under chapter 6A will be allowed for computing the book profit. No exemption. Okay, this is the case of NJ Jose and Company Private Limited. The case was delivered by the Kilera High Court. Is this clear? Now, coming to the first point. We have said it is a income, the total income. We do not need to edit any other income, but the income from the suppose we have earned some income from the other sources, say the interest on the saving bank account. Okay, so, or maybe the other income from the dividend income. Suppose the dividend income that we have earned is available there. So, the other sources income will be available in the credit side of the profit and loss account. Okay, we have not said to reduce it or to add it and on the above portions. Okay, suppose not, if you take any kind of other source income, take any kind of net, capital gain income, take any sort of house property income, if they are not added back or subtracted in the list that we have just studied, so they are already credited to the P&L account, so we will not exclude it from the profit. They will be added, they will be kept added in the profit or loss account in the to calculate the net profit. Is this clear to you all? See, if the income chargeable under the other heads of income like capital gain, income from other sources, are credited in a statement of profit or loss, then these will not be excluded from the profit. Now coming to the point number 3, we are keeping the contrary ruling just pending for a minute. First, we'll read the point number 5. Point number 3. Point number 3 is a subsection 5 of 115 JB. It is a subsection 5 of 115 JB. What it says? It says the save as otherwise provided in this section. In this section, what? 115 JB. Whatever they said it to add, added, whatever it said to subtract, subtracted. Save as otherwise provided in this section. All other provisions relating to carry forward, set off, advance tax, interest under section 234B, 234C, and the penalties, all will be applicable. What if these lines were not written? What will happen? The company says we are not filing the return. Okay, we are not filing the return. What the government will do? Government has no power to impose the section 234B or section 234C, 234A interest. The government is not empowered to take the penalties. The government is not empowered to take the advance taxes from us, because this section already overrides the whole income tax act. So all these provisions will not apply. The company did not take any undue benefit from these provisions. The government has to take care of this and write under the section subsection 5 that save as otherwise provided in this section. All other provisions such as related to the carry forward and set off of losses, advance tax, interest under section 234B, C, and penalty shall apply to the company even if it is liable for MAT. Is this clear? Now it is, and now on this point number for subsection 5, there is a contrary ruling. The contrary ruling is of CIT versus Metal and Chromium Platter Private Limited. It is delivered by the Madras High Court. Whenever Madras High Court comes, it takes our effort, and they compel us to solve the questions twice, first from the normal provision and second from their point of view. The same we have done in the case of the Manjula Shah, and here also we are doing the same, the contrary ruling we are giving. What is the contrary ruling? They said whatever you want, that we will disallow it, so you have to write it in the section. You have written that the book profit means. You have written the book profit means. If you are saying this means, so write everything. Write every section, whichever is allowed, whichever is not allowed. If you haven't written here that the section number 54 EC deduction is here, is allowed, we will not give anything. You have written the book profit means, so we will take it as a literal interpretation. The first rule of interpretation of the statute is the literal interpretation, and we are doing the literal interpretation here. So every whichever is written in the addition point or the subtraction point, we are doing only that. Here nothing is written that the section number 54 EC deduction will be available, so we are not giving it. So the Madras High Court want the government write each and every point here and there, that this is applicable, this is not applicable, this is applicable, this is not applicable. So this is the contrary ruling. This ruling will be binding in the Madras, but not in every corner of the state or every corner of the country. Okay, so this is a contrary ruling that you should write in your examination. If this question comes in your examination, solve as per the subsection 5. Take everything. Take the set of provision, take the advanced tax provision, take interest as well, take penalty as well, and after that write a explanation that there is also contrary ruling available of the Madras High Court in the case of CIT versus Metal and Chromium Platter Private Limited. In this case, the no deduction will be allowed, as the book profit the definition of the book profit is given in the exhaustive sense. So except is specifically barred by the section itself, we are not allowing that. Is this okay? So the Madras High Court have held that subsection 5 of section 105 JB, that is the section, allows for application of all other provision contained in the Income Tax Act except is specifically barred by that section itself. Thus the book profit would be further eligible to the benefits set out in the other provisions of the Act. Accordingly, held that the capital gain which form part of the net profit in the statement of the books of profit or loss, in respect of which under section 54 EC is available, should not be taken into account for the calculation of the minimum alternative tax on book profit under section 115 JB. In view of this ruling, such exempted capital gain will not form part of the book profit. That the exempted capital gain under section 105 EC will not form part of the book profit, as you have not written here and there anywhere. Is this clear to you all? All the important remarks are completed, but just 2 points are left. That the report of the CA will also be applicable in this case, who will certify that the computation of the book profit is perfectly fine, and the report will be submitted in the form 29B 1 month prior to the return of income. What is the date of return of income to the company? Is 31st of September. Sorry, 31st October, and if it is a case of a transfer pricing, then it comes to 30th November. But what is 1 month prior is 30th September is the due date. 1 month prior, say 1 month prior to the due date of ROI by company liable for MAT. Now what it says under the point number 5, any income of a company from life insurance business will not be liable for MAT. Now suppose a case where I am a PV Limited doing a business, three kinds of business. I'm doing a life insurance business, I'm also doing a health insurance business, and I'm also doing the general insurance business. So suppose the income earned from the life insurance is 10 100 crores, out of which the expenses has been incurred for 50 crores. And suppose for the health insurance we earned the income of 500 crore, expenses of 100 crores, and the general insurance suppose 400 crores, and the income will and the expenses are 60 crores suppose. Okay, so the what the point number 5 says, any income of a company from life insurance business. So this business is out of purview from the MET, but these will apply. But the MAT will apply on the health and the general insurance. So after this, what is the net profit? 400 CR or 340 CR. So it comes to 740 CR. On this, the MAT provisions at the rate of 15% plus applicable surcharge rate plus 4% of cess shall be applicable. Only the life insurance business is exempt from MAT, not the whole VB Limited. Is this clear to you all? You clear? Any income of a company from life insurance business, the income is exempt, not the company is exempt. Okay, so income, that is a life insurance income, will be exempt from the MAT, not the health insurance and the general insurance business. Is this clear to you all? Clear. Now coming to the rationalization of MAT provisions in line with the IND AS. Now what is the need of this rationalization? Suppose if in the intermediate you have also studied the accounting standards, and now in final you are studying the Indian accounting standards. The major difference on both the accounting standards were, firstly, the IND AS says take everything on the fair value, but in the AS they say take it as on the historical cost basis. We are not objecting anything. So the one provision, the NDS is saying take it on the fair value, and all the AS are saying take it as a actual value. So the government is habitual of the actual value, the historical cost basis. So they are saying the income, the IND-AS, the Indian Accounting Standards, and had come up with the concept of OCI, the other comprehensive income. You have studied in the FR as well. There is a net profit, and while preparing the statement of profit or loss, there is a net profit, or then we add the other comprehensive income, then total comprehensive income, then total profit that we showed here. So the government is saying take the net profit before the other comprehensive income. Before the other comprehensive income, we are not habitual to the other comprehensive income. This is a new concept under the Indias. So the government is saying take the net profit before other comprehensive income under the step 1. Then the step 2, do all the adjustment as we have studied it just earlier. Do addition, do subtraction as we have said. These are the two steps. Now what are the third step? The government said there is some OCI that will not be reclassified to the PNL account. You have studied the OCI NR, OCI which is not reclassified to the PNL. So these kind of OCI will have some impact. What is the impact? See, under the Ind AS 16 or Ind AS 38, Ind AS 16 is of PPE and Ind AS 38 is of intangible assets. Okay, under these two, when we do the revaluation, when we show it on the fair value method, we create some OCI. These are the notional gain. We do not realize it. This is only the notional gain. That is why it is given in the OCI. Okay, so the government is saying this is the notional gain. This is not the actual gain to you. So do not calculate, do not add into the value of the net profit in the year of this creation. Just add in the value of the net profit when this actual gain, when this notional gain becomes the actual gain. So the in the year of the transfer in which the actual gain arise, take it into the book profit at that year, but not in the year of making of OCI. The same treatment is given for the 109, the financial instrument as well. In the financial instrument chapter as well, we create the OCI and we create the OCI NR, and for OCI, and that for OCI NR as well, we will not credit the gain or loss as the case may be in the year of creation of that OCI, but in the year when the actual gain or loss will arise. Is this point clear? So see, what is the point number one? Step number one is to find out the net profit before other comprehensive income as per the statement of P&L. Then step number two, existing provisions, make all the adjustment as per the existing provisions. And step number three, make further adjustment pertaining to OCI that will be permanently recorded in the reserve, that is never reclassified to the statement of P&L. These items shall be India's 16 and India's 38, that all I have explained, the PPE and the intangible asset. Revaluation reserve credited or debited to the comprehensive income, the comprehensive income shall not be adjusted in the book profit in which it is debited or credited. It shall be included in the book profit of the year in which the such asset is retired, disposed, realized, or otherwise transferred. This is the year in which the actual gain will arise. So in the year when the actual gain will arise, we will take then, otherwise we are not going to take the OCI at the year of creation. Is this clear? The same for the ACI, for the Ind AS 109, for the fair value through OCI, FVT OCI we do, and there are two methods in the Ind AS 109. Is one is FVTPL and FVOCI. So FVOCI we are talking about here. When it comes to FVTPL, so it is already transferred to the PNL, so it is not considered here, as it is already considered in our book profit, in our net profits. Okay, is this clear to you all? The same thing here, the gain or loss of such from such investment credited or debited to other comprehensive income shall not be adjusted in the book profit in which it is debited or credited. It shall be included in the book profit of the year in which the investment is realized, retired, or disposed. Now coming to the next point, if there is a in AS 19 and other income, then what we'll do, we'll add back the gain and we'll deduct the loss. Okay, to be included in the book profit every year as the remeasurement gain or loss arise, because as for these cases the fair value is also suggested by the AS. So the government is taking it as per the AS, so there is a different treatment. We have to take it on the every year. The book profit every year has been remeasured, and the gain or loss arise shall be adjusted to the book profit. If the gain arise, then you have to add it to the book profit. If the loss arise, then you have to deduct from the book profit. Is this clear to you all? The Ind AS approach is clear. Now coming to the transitional amount. What is the transitional amount? See, when you are converting from AS to Ind AS, you will have some differences because of these things. because of these three things you will have some differences in your accounts. These are the transitional adjustment, the adjustment for because of the transitional transition from AS to Ind AS. So this is the amount should be given by the question. So what you have to do, you have to do it 1/5 and take it for the take it for further 5 years. Is this clear? If it is credited to PNL, then you have to add, uh, if the credit balance of transition amount is given, then you have to add it back to the net profit, and if the uh, debit balance of the transition amount is given, then you have to deduct. But what you need to consider, the transition amount does not include five things. What are these five things? These five things are CS rot. What are these CS rot? CS rot is, first is capital reserve, second is security premium reserves, third is any revaluation, O is OCI balance, and T is any translation difference of foreign currency as per Ind AS 21. So these are the points which will not be included in the transitional adjustment. After reducing all these CS rod points, the net amount of the transition adjustment should be done 1/5, and if the amount is credit, then it should be added back to the net profit, and the amount which comes is debiting, so it is deducted each year. See, in computing the book profit of the year of convergence and each of the following 4 years, 4 years, 1/5 of the transition amount, excluding capital reserve and security premium reserve, will be added each year if credit balance of transition amount is given. Conversely, 1/5 of the transition amount will be deducted each year if debit balance of the transition amount is given. Is this point clear to you all? Clear. Now the effect of book profit in case of applicability of AP and the secondary adjustment. This topic, as I have said, this topic will be done with the transfer pricing chapter, not here. As here I have to explain the AP and the secondary adjustment, which might get heavy at this point of time. So when we'll do the transfer pricing chapter, we'll understand the AP and the secondary adjustment first, and then come with this point of Ind AS. Is this clear to you all? So we are not doing here the met provisions of the AP and the secondary adjustment. We'll do at the time of transfer pricing. Is this clear? Now the point is of met credit. Now what the objective of the met credit was? The individuals like us, the company like us, what are they saying? They are saying that we were actually liable to pay the normal tax as per the PGBP, but because of the section that you have introduced, for that we have to give the excess tax, that we have to bear the excess burden on us. So give the credit of that excess burden when we get the normal income higher than the met income. The normal tax payable becomes the higher than the met income. Give the credit of the excess burden that we bear. Okay, so the government said, okay, we will give you. So what is the credit will be allowed? That the tax under the met is greater than the tax as per the normal provisions of the act. The difference of that amount will be considered as a credit, which will be carried forward for the 15 years, will be carried forward the 15 years succeeding the previous year in which the mat has been paid. Okay, this will be carried forward for the 15 years. Okay, this is clear. Now till at what extent the credit will be available? The credit would be available to the extent where the normal tax payable is higher than the net income. The normal tax payable is higher than the net income. The only differential amount will be allowed as a deduction. The normal tax payable less the tax payable as per the met provisions, no interest shall be payable on that tax credit. The tax credit, you will not say to the government that for the 15 years you are carry forwarding our met credit, you have taken it 15 years back, now give us the tax interest as well. The government is not going to give any interest, and this is the point you can skip very skip very leniently. The ICA has not asked it till yet, and they are not going to ask it as well. This is the point which is given in the book. I have written here. Otherwise, these are the credit points. Okay, the credit will be available for 15 years. What is the credit available? The tax paid minus the tax payable as per the normal provision. This is the net credit amount. Okay, and to which extent? The extent will be given to the normal tax payable minus the the net provision. The excess of that will be available. Suppose in this example, suppose for this I am giving you an example. Suppose the net credit which I was carry forwarding is of 500. Suppose 5 lakh rupees. Okay, suppose this is carry forward. And now in the year, the assessment year 24-25, what has happened? That the tax at the normal rate becomes 10, suppose 10 crores. Okay, met comes to suppose 99 lakh, sorry, 99 lakh, okay, 9 crore 90 lakhs. So the only difference is of 10 lakh rupees. Okay, so here the 5 lakh rupees will be allowed easily because the difference is of 10 lakhs, so they can easily allow me 5 lakh rupees credit. Now suppose another situation. This is not 9 crore 90 lakhs. Suppose this is 9 crore 99 lakhs. So here the difference is of only 1 lakh. So the whole 5 lakh will be allowed? No, the whole 5 lakh will not be allowed. Here the case 1 lakh will only be allowed, and the balance 4 lakh rupees from here, the balance of 4 lakh rupees will be carried forward for the remaining assessment years. Is this clear to you all? The met provision is clear to you all? Clear? Now, the last point, alternate minimum tax for a person other than a company. See, for the company, they have come up with a minimum alternative tax. Now they want to tax the company, they want to tax the persons other than the company. What are those persons? They can be AOP, BOI, individual, HUF, firm, AJP, HUF. They can be anyone other than the company. Okay, as the this provision, AMT provision, is almost similar to that. What is this? The normal income tax provision, the sum that we have calculated as per the normal income tax provision plus applicable surcharge rate plus cess, if it is less than the 18.5% of the adjusted total income. It says adjusted total income. In the med, it was the book profit. Here the base is the adjusted total income, and here it is 18.5% instead of 15% as per the med. Okay, plus surcharge plus cess, whichever is less, whichever is more, the tax should be given as per that income. Okay, in this case the adjusted total income shall be shall be deemed to be the total income as same in the met as well, and here as well adjusted total income multiplied by 18% plus surcharge plus cess will be the final tax paper. Is this clear? Now, as same in the MET as well, the IFSC will be taxed at the rate of 9% instead of 15%. Here as well, and the IFSC will be taxed at the rate of 9% instead of 18.5%. Is this clear for the IFSCs? And now the additional benefit under AMT is given to the cooperative societies. The cooperative society will be taxed at the rate of 15% instead of 18.5%. Is this clear? The additional point that you have to remember is for the cooperative societies that the tax rate is not 18.5%. Instead of 18.5%, it is only 15%. Is this clear? Now what we have to calculate the adjusted total income, because it is the base of computing the AMT. So for the adjusted total income, what you have to calculate? First calculate as per the normal provision. First you have to calculate the total income as per the normal provision. Take all the deduction that is applicable to you. Okay, if you have taken any deduction under this section 80 IA to 80 RRB, this is a profit linked deductions, so add it back and just if there is any deduction of 80p, do not add it back, because we are going to give the benefit to the our cooperative society, because we have also reduced the tax rate for them. So to give the benefit, we have excluded the section 80p from the addition list. It is a deduction to the cooperative societies. Okay, so 80, except for the 80p, and any profit link deduction is available, so we have to add it back. Then we have to edit back section 10AA exemption. 10AA deduction is available to any SSE, and they have taken the deduction of it, so we have to add it back while computing the adjusted total income. And thirdly, what is the what they have added? They have added the section 35AD deduction to be added back to the adjusted total income calculation. But they have said that while computing the 35AD, you have taken the 100% deduction, but for the adjusted total income, do not add the whole 100%. But what you have to add, see, if there is something, if there is a hotel that you have made for the four-star hotel, that comes under the section 3580's scope. So suppose it's of 100 crore, hotel is of 100 crores value. Now you have to calculate the depreciation on it. Suppose the depreciation applies at the rate of 10%. So we reduce the 10 crores. Now 90 crore is the final value. So the final value will be added as adjusted by the notional depreciation, that you have to apply that notional. If the section 3580 was not applicable, then the notional depreciation will be of the 10% instead of taking the 100% deduction. So the additional notional depreciation what will be the 10 crore will be minus, and only the 90 crore will be added to the calculation of the adjusted total income. Is this clear? Same as per the MET, you have to report. The report of a CA is also made applicable here, same as the 1 month prior to the due date of filing of return to the assessee liable for MET. Here the assessee return due dates may vary from 31st of July to any date. Okay, and then the tax credit provisions is also similar to the MET provisions, that the MET is are similar to the MET provisions. Here also the credit will be given to the 15 years succeeding to the previous year in which the credit was availed. Is this clear to you? Okay, now application to other provisions of the Act, same as per the section 115 JB subsection 5 we have done. This is the same as otherwise provided in this chapter. All other provisions of this Act shall apply to the person who is liable to pay AMT, meaning thereby all other provisions such as relating to the advance tax, interest under section B 234B, 234C, and penalty, etc., shall apply in this section as well. Is this clear to you all? Now coming to the point number 5. Point number 5 says the applicability of the chapter, the AMT. The applicability of AMT will only be when the person having the deduction under section 80IA or 80IRR till 80IA to from 80IA to 80RRB, section 10AA or section 3580. Because if these are the sections not included as the assessee is not entitled for these type of sections, so what we will calculate the adjusted total income. The total income will only be the adjusted total income, but we want to calculate for these type of income, for these three incomes. That's why it is made mandatory that income for the person who have these three kind of deductions will be eligible for the AMT. Otherwise, any other person is not liable for AMT. Is this clear? Then the second condition is the adjusted total income should exceed 20 lakhs. If the individual HUF, AOP, BOI, AJP, then the adjusted total income, see here the firm is not written. The firm is not written. Then the adjusted total income should also exceed 20 lakhs. For firm, there is no such limit. Is this clear? Clear? No. While uh, um, suppose for the assessment year 2021, I have paid tax as per AMT and my normal provisions was less. The tax as per the normal provision was tax, and I have paid tax as per the MET, and here it comes the MET credit. Okay. Now for the assessment year 24-25, my adjusted total income is less than 20 lakh rupees. So the AMT is not applicable to me now. the AMT is not applicable to me now. So when I want to claim this AMT credit, can I claim? Because the in the provision says that the applicability of AMT chapter will only be available if your total income, if your adjusted total income exceeds rupees 20 lakhs. But here my adjusted total income reduces from 20 lakhs. So can I adjust that AMT credit? The government said yes, you can adjust that AMT credit. The limit of 20 lakhs is not to be seen at the time of adjusting the credit. Is this clear to you all? See, credit can be claimed irrespective of the limitation or condition as per section 115 JEE, that is this section, even if condition of claim of deduction under section 80IA etc., and in case of individual etc., adjusted total income does not exceed 20 lakhs and not being fulfilled in the year of the claim of credit, still credit can be claimed as a part of 115 JD. This is your whole chapter of MET and AMT. I hope you enjoyed this session. You understand each and every point logic and each and every point reason behind introducing in AMT and the MET. This is the whole chapter. Uh, Now I have given you some question and answers. The question number one, question number two. You can practice all these questions. At least do the MET portion, because in the question of MET, the question of PGBP also comes. The knowledge of PGBP is also tested in the questions of MET. So if you are able to solve it by your own, do it on your own. Otherwise, after the PGBP chapter, we will take the questions of the MET as well, so that we can get it. We can get the very basic, and we can get the very fluent understanding of each and every point that the question is asking, because while solving these type of questions the knowledge of PGBP will be required. So after the PGBP chapter concepts, we will solve all the questions of the MET or AMT as well. If you have already completed the PGBP chapter, then you can try these type of questions. You will be able to solve each and everything in this chapter. I am guaranteeing you, now you know each and every point, what you need to add or what you need to subtract. Is this clear to you all? No, if you have any doubt, I am available in the chat box or in the live chat option. You can ask me there. Otherwise, the Telegram link, Telegram channel or group link is given in the description box. You can ask me there as well. Is this clear? I hope this chapter is very, very, very clear to you all. I tried to make it as simple as possible for me. Now you have to just revise it once or twice, either either watching through this video or by your own from the self study. Is this clear? Let's meet in the another session on the DT exemption series. Till then, take care and study hard. Study hard, practice a lot, solve each and every questions by your hand. Okay, till then, take care.